Okay, in this interview, we have an amazing macroeconomic researcher who has some incredible research, especially for you as an investor. And his name is Luke, and he has a pretty interesting company you could see behind it. It says, "Don't miss the forest for the trees." That whole type of motto is kind of something you don't see that much as it pertains to finance. And I think it kind of also sums up your work super well, right? Because you're seeing this way larger macro view that a lot of us caught in the matrix or caught in our emotions or caught up in a year. We don't see what's really happening. And so I'm excited to talk to you about the future and your views and all that.
I'm excited to be here. I'm really excited to be on the show, and I really appreciate the invitation.
So let me ask you, what do you think is the forest right now that everybody is missing in 2021? I would say like 2020 is like the trees, right? It's a super emotional, crazy year. You had all these people afraid of dying and people afraid of losing their jobs and, their stocks going down. And then people are wondering about the economy, and it's just been a roller coaster in a lot of ways, but there's a larger economic agenda at play that you've really been researching. So what do you think this forest is leading us if 2020 has been or the government response to COVID has been the trees? Where's the forest?
Where's the forest? So to mix my metaphors a little bit, there's an old saw that says if you asked a fish to describe its environment, the very last thing it would list would be the water. Huh. And I think with that metaphor, when you say if 2020 is the trees, what's the forest? I think what 2020 has brought forward has been something we've been describing in our work for quite some time, which is ultimately you have this problem of unsustainability. It's an unsustainability of going back 80 years, 90 years, back to the 1930s, when really the genesis of what I would call Western social democracies, where up until that point, the state had a very limited role in guaranteeing people's health, retirements, et cetera. And so we began to see in the 30s this, obviously FDR with the Social Security was sort of the first. You began to see the development of these social promises made by the state, Western social democracies. And this unfolded 30s after World War II. You get to the 60s, you have the rollout of the Medicare, Medicaid, Lyndon Johnson Great Society. And so you have this combination of things, which are the surplus, the economic surplus generated through both industrial and the commercialization of fossil fuels, other productivity increases, technology, and Eisenhower highway system, just this massive productivity increases generated the economic surpluses so that these social safety net promises were able to be credibly promised. And what that ultimately did was pull forward demand, because if you think about it, up until the 30s, no one was responsible for your retirement except for you. And in fact, retirement wasn't even really a thing. You pretty much worked till the day you died. And so once you didn't have to think about saving for the future, you can start spending more today. And so you have this giant combination of the social promises made credible by this massive productivity tidal wave. The demographics were supportive with the baby boom generation from the 40s, 50s, 60s, and as they flowed through the economy. And so you had all of this. And so the forest to me is really, we got on the back end of this, particularly in the aftermath of the 2008 crisis. It's been really a boulder that's been rolling downhill slowly, or a snowball rolling downhill slowly. And COVID really accelerated this meaningfully. And so to me, if you say 2020 and COVID and the response was the trees, the forest is really the revealing that this fundamental problem, which is the promises of the state and in terms of both these sovereign pensions, these entitlement programs, but then also just the underlying assumptions to a lot of the private pensions state pensions, they're not sustainable on a real basis and anything resembling a real basis. And so it's now the COVID has brought forward the forest, if you will, is who's going to bear the brunt? Is it going to be the debtors, basically, or the creditors? In other words, are we going to reform or cut these pensions, these entitlements? Are we going to force people to cut back their living standards and break these promises on a nominal basis? Or are the central banks going to create currency to keep these promises whole on a real basis, on a nominal basis? But on a real basis, what we're talking about is inflating them away to some pretty notable degree. And so I think the forest is really this fundamental long cycle breakdown between the promises of the state that we all grew up with as being just sort of understood to be true, and sort of a breakdown of that narrative.
Man, that was amazing. So it's also, I obviously haven't done 1/1,000,000th of the research you have, especially as it comes to pensions, but I did read a couple books on that. Robert Kiyosaki wrote that book. That was kind of maybe a good mainstream approach, which was Who Stole My Pension? And I don't know anyone that knows this. Like, I remember reading it and then like telling people about it. And I was like, no, I never heard of that. And then like looking at a lot of them, and I mean, some of them were like in the single digits percentile of being funded. And then there's all hairy stuff, and that's the hairy stuff of some potential foul play, but we don't need to go there. But there's so much money promised. Robert said even before COVID happened, or the government response to COVID, I should say, happened, he was already saying every other crisis is a hiccup until the pension crisis. And like every state's underwater and blah, blah, blah. And so to me, it doesn't even seem like it's in the realm of possibility for the government to do the former, which was, you said, having cut back everything, et cetera, et cetera. So where do we go from here? Is there any doubt in your mind that they're going to inflate this away? Then we also now have all these new promises because, the UN said 250 million people are going into poverty. That was in the summer from the COVID lockdowns. And that was before they locked everything down again right now. So maybe it's even higher. So there's going to be that new level of social promises. So like, what is going to happen? What are they going to do? Like,
I don't envy them. This is a problem that you knew about it actuarially, right? You knew 70 million baby boomers were born from 1946 to 1964, and so you knew that stood the reason that they were going to reach age 65, and so it was. People say, well, who's to blame? Really, no one's to blame. Human nature is to blame. This is sort of the story that has just repeated itself over and over and over. Now, to Robert Kiyosaki's point, this iteration of this problem, which is there's been all these promises made and there's not the ability to keep them whole on a real basis, has, in my opinion, or in my research, I have not found any examples in history that it has been this big. And what I mean by that, you've had, the demographics accelerate so meaningfully over the last 150 years, right? So from year 0 to year 1850, it's estimated the human population grew 1% a year, maybe a little more, maybe a little less. And then as soon as the Industrial Revolution led to the commercialization of fossil fuels, that rate of growth from 1850 to 2000 ramps up to 5 to 6% CAGR, right? So you've got this massive increase in productivity, massive increase in population. Then we start making promises based on that higher acceleration, and just basically expecting that rate of productivity growth to continue. Now we've had this slowdown in population growth. They've found a good correlation that, hey, if you increase education, you slow the birth rate. I think there's a there are ways to manage out of that, but you still can't get around the demographics of as that population slows in terms of the birth rate, you get upside down on all these promises, these pensions, and these social obligations. And so it really comes down to, do you cut or do you print? And it was always going to be a choice. If you read policy makers from the Fed and from others, you can go back over the last 5 years, 10 years, we've written about it several times, a bunch really, where they discussed these things. And it's hard because it's almost like when you have, if you have a disease, if you go and get treated right away, a lot of times the disease is treatable. You go see the doctor, you try to get it fixed, and away you go. But if you don't go to the doctor and you let it grow and you let it grow and you let it grow, at some point on that path, the doctor says, look, I'm sorry, I can't help you. And it comes, it turns into making you comfortable until you pass. And unfortunately, it's sort of a morbid metaphor, but from a fiscal standpoint, I've joked. It's the metaphor I've used is the only way to fix this now, unfortunately, when you say, okay, cut or print, the problem is we've let this thing go so long. Cutting's not really an option, because if you cut, you immediately crash tax receipts so much that you could actually cut spending and end up needing to print more. In other words, your government receipts might actually fall because you've allowed the government to become such a big portion of the economy. And so it becomes sort of circular. And so I've said the metaphor is that if you wanted to cut, you would need an 83 DeLorean with a flux capacitor, right? You need to, go take the time machine, go back to, 1980, 1970 sometime, and basically reverse some decisions that were made or make some decisions that weren't made that would have required a tremendous amount of political courage, or that just weren't politically possible for any number of reasons. But as I look at it, to answer your question directly, I don't see any other way out other than trying to effectively print their way out as fast as they can without having without the currency revolting, basically.
Are you surprised that they haven't done this next round of stimulus yet? And where do you think we are right now? Like for me, there's also a lot of things that I would like to say, but due to like the algorithms on YouTube, there's some things that, I could say that would affect the channel in a negative way. But speaking on strictly what you think will happen next, I'm honestly surprised that they haven't done the stimulus. And I think at this point, it's a humanitarian issue. They've enslaved an entire world in the worst way possible. And now they lock them in their house, and there's food banks across every major city. I lived in Maui. It brings tears to my eyes. I lived in Maui. Dude, it's 7-hour food bank lines around the whole island, and it's in every major city, and they're still doing, no, 900 billion, no, this, and they're just whatever they're doing. It's I'm starting to wonder, are they doing this on purpose? Are they literally doing this on purpose? Because, dude, before this happened, 75% of people already lived paycheck to paycheck, and the average American couldn't come up for $500 in emergency already before. I'm just what is happening? And so, first of all, are you surprised it hasn't happened yet? And what do you think is gonna happen? You've even seen some banks now that are starting to go no, it's going to be small stimulus now. I think Citibank or someone was no, now it'll only be 800 billion. I'm dude, now you made it needs to be 100 trillion because you've waited so long. So yeah. What are you surprised that it hasn't happened yet? And what are your thoughts on it?
I was surprised. I continue to be surprised. I was surprised they didn't do it before the election. It was, and it is quickly becoming a humanitarian issue. And when you look at the Wall Street Journal had something last week looking at the numbers of people at risk of being evicted, when the eviction moratoriums expire, I want to say in either January or March. It's one of the two, I forget. The food bank issue, I think it's been an issue around the country that you cited. I think I'm trying to be democratic here or as well. I think Washington's politicians, a lot of not all of them, because I do think some of them are really in touch and really understand what's going on and are fighting the good fight. But I think a lot of them are caught in the inertia, either the inertia of kind of the dogma of the politics, right? So when you're in this political fight in the trenches, you're not thinking outside of your trench. You're thinking about, I gotta beat that guy right there. I gotta get my way so he doesn't get his or hers. And you're not thinking about the bigger issue here. And so I think there's just an element where they're a little bit out of touch, to be blunt, in terms of, I think, well, at least how they measure this relative to the crisis. Now, I think that's part of it. I also think there's a part of it that I think once the COVID thing hit, it's the work we've shows that if you look at entitlements, defense, and interest expense, gross interest expense. And there's a report out every quarter called the Treasury Borrowing Advisory Committee's report to the Treasury. Treasury Borrowing Advisory Committee is like a who's who on Wall Street, senior people, investment management firms, bond firms, investment banks. And they basically look at a whole bunch of different data as it relates to Treasury issuance and tax receipts, et cetera. And they make the recommendations to the Treasury. And so the most recent, I've been watching this report for, probably 5 years now. And when I first started watching this report, if you look at just the three biggest things the U.S. government spends their money on, there's entitlements, there's defense, and there's interest expense. And at that point in time, it was about 85% of tax receipts. And you say, okay, that's not good, but you could see the rates of growth. Tax receipts were growing 2%, and entitlements were growing 6%, and defense was growing 5%, and interest expense. So I said, okay, if we run this out, it's just a rough analysis, but it gives you a sort of bigger than a breadbasket way of just analyzing on a gross basis, sort of the big years of how bad the fiscal situation is getting for the United States. And in early 16, it was 85%. We said, okay, if we run these numbers out, by maybe late 21, early 2022, we're going to be over 100% of tax receipts in the big three. And that leaves everything else out. We'll be borrowing to spend everything else that the U.S. government spends money on, right? Which is incredible. And then the Fed started hiking rates. And instead of it being in late 2021, early 2022, it actually, by third quarter of 2018, it was at 103% of tax receipts. So we blew through that number a full, basically 3 years earlier than I would have thought. And I thought I was relatively, I wasn't overly aggressive with the numbers, but I wasn't conservative either. And we blew through that 3 years early. So, okay, we're at 103% in 3Q18. That's not good. We start to have those problems in 4Q18, Fed reverses. We go through the COVID crisis. After the COVID crisis, we're at 140%. Just entitlements, defense, and interest expense. Now, they lump Treasury spending in with gross interest expense in the most recent reports, which send it shooting up. But a lot of that are the COVID measures that are, keeping the lights on. As bad as things are, that's stimulus that is keeping people at least hanging on by a thread in a lot of cases. And so the point in all of this is to tie it back to my initial point of A, I think some of them are out of touch in Washington, but B, I think part of it is trying to spin the unspinnable, which is to say, once you're at 140% of tax receipts just for your big three expenditures, you're done. There's nothing more you're trying to sort of, figure out how to spin the unspinnable, which is the Fed's going to have to get involved in a big way. The dollar's likely going to have to suffer. And how do we spin this? And there's nothing to spin. And so I think that's part of it too, is in politics, it's not about what happens, it's about who gets blamed, right? It's and so I think there's an element of what's going on that is, oh my gosh, we were told we had a decade and we didn't. And now what do we do, right? And so that to me is that I'm trying to figure out, and I don't have the answer of who, like I said, it's human nature, but I think that's part of this infighting of 900 billion or trillion or I think there's something bigger happening here where they're realizing their goose is cooked and they're trying to figure out who's gonna wear this, right? Who's gonna be blamed for it.
So if that's what's happening, then how do you think these last couple weeks of the year and then the start of 2021 unfold in that? Yeah. What do you think happens?
I've been surprised how well the markets have held up without the stimulus. I would have thought they would have performed worse than they have, to be blunt. Every day that goes by that we don't get some other sort of stimulus or what have you, given this gap, to me is, I think a risk that you do get. I think a key portion of the recovery and the economic growth has been associated with rising asset prices. As intellectually offensive as that is, in some ways, a critical portion of GDP growth is because asset prices are rising. And so if that reverses, you go from, the K-shaped recovery, the so-called K-shaped recovery, to, I don't know, is that a lambda or something, some Greek letter where there's the upper part of the K joins the bottom part, right? And so to me, it looks like they're going to try to get something done, but then you get, this sort of period of time where I guess some of the stuff that the Trump administration did rolls off. You get, in theory, maybe an air pocket or a period of time. How long does it take for the Biden administration to really get programs going? Can they go day one? In theory, they can. To me, that's maybe one of the big questions is, how not progressive per se, but how activist is he going to be in terms of attacking this? How activist is his administration going to be, or is it going to kind of be more of the same in terms of the political infighting? I just don't have a great feel for it, but I think the longer it goes on, the risks. I think your point of the longer it goes on, the bigger the package needs to be. I think that's a valid point.
So what is your inkling on which way they would lean?
The incoming administration?
If the Biden administration ends up taking office, where do you think they'll lean? There's the people that think, it's going to go straight to like money being droned to your house. There's other people that, Citibank or one of these banks said only like 800 billion is going to come and that's it. We're done. Where do your expectations lie?
I would lean more on them being more aggressive, is my baseline scenario right now. There was a Zoom panel that was held between the Brookings Institute and the Peterson Institute, I guess about 10 days ago, maybe almost 2 weeks ago now. And it was a who's who of former central bankers. And so it was Bernanke, it was Ken Rogoff, former chief economist of the IMF, Larry Summers, former Treasury Secretary and head of the National Economic Council under Clinton. You had Jason Furman, who was Obama's chief economic advisor, and Olivier Blanchard, who was also a former chief economist of the IMF. And they're doing this call, and the title of the panel was economic advice to the Biden administration and Congress. And it was the basis of the call was Furman and Summers have a new draft white paper out talking about the same subject, advice to Biden and the administration and Congress. And their advice is, in a nutshell, keep interest rates below the rate of GDP and debt doesn't matter. And they're right. I mean, if you keep interest rates below the rate of GDP growth, then it's never, your debt will never matter. You will outgrow, it's basically what the U.S. did after World War II to delever. Is from 1945 to 1980, the U.S.'s GDP, nominal GDP growth consistently ran 500 to 800 basis points above the yield on the 10-year Treasury for the better part of 35 years. And so what that's telling you is U.S. debt to GDP at that time went from 100% to about 30%. As the economy grew way faster than the interest on the debt accrued. It was a great deal for the United States. It was not a great deal for people who held Treasury bonds. Your purchasing power got crushed on a real basis relative to GDP. And basically what the advice they are giving to the incoming administration and to Congress is to run the exact same playbook. Except now we are more indebted. We have, just on the debt side, corporate debt's higher. We have the derivatives. We have the demographic side, and with the demographic side comes the entitlement problem as well, which is effectively another 500 with a debt that's another 500 to 1,000% of GDP. And so, arguably, the rate of negative interest rates, negative real interest rates, would have to be much higher. And that's where I think this would appear to be the advice that Biden and the incoming administration are going to get. And given how little else there appears to be in terms of politically palatable options, I think they're going to follow that. And so to me, the big takeaway for me is right now there's this consensus that real interest rates, which bottomed at negative 1.1%, right? So you're just looking at the 10-year yield minus the inflation rate, the official inflation rate. That number was negative 1.1% in August, and has risen slow, rose slowly. It's backed off a bit, but that's been the low. And consensus is still that's as low as that number is going to get. And to me, I think that number is getting way lower. I think that number is going to -5, -10%, maybe even lower in coming years, which bodes really well for gold, silver, Bitcoin, et cetera. But I think, to answer your question directly, is I think those are the policies. I think we're going to basically significant increase in federal deficits effectively monetized by the Fed for a number of years to come to ensure that real rates stay very negative.
The only solution I think I could probably get, if I was in that meeting or if I was on that Zoom call, I would be advising them to buy like penny stocks. That seems like the only solution they have. No, just joking. But so you think, because gold, a lot of my interviews are about gold and silver. So it's struggled. What's your view on it right now? I bring it up because a lot of people say gold's been struggling because the treasury's been rising, and then a lot of people say the gold rally's over because it's not going lower and the dollar's holding, and you say you think it's going lower. So what are your thoughts on gold and where you see it right now?
I still really like gold. Gold's still my favorite asset. And it's still my biggest holding personally. Ultimately, the fiscal situation's untenable. Real rates are going to have to be a lot more negative for a lot longer than virtually anybody thinks. And historically, if you look at the price of gold, it is very inversely correlated to real rates. So the lower real rates go, the higher gold goes. And so I think ultimately, I understand why real rates have risen or off the lows. They're still negative. I understand the excitement and the possibility of renormalization around the vaccine and the reopening of economies around the world next year. That may or may not be overdone. My gut tells me it's probably a bit overdone.
You're nuts if you think that it's not overdone.
But bigger picture, I think people are missing the point, which is there is a yield on the 10-year where the Fed's going to come in my view, and say, that's it. It's not allowed to rise anymore. Because again, we haven't seen this in 80, 85 years, which is if the interest rate rises too high, the nominal solvency of the U.S. government will come into question. And that is not going to be allowed to happen. Because basically their debt is so high, their obligations are so high, it's such a financialized economy. Interest rates get too high, and you're going to have an increasing amount of the of tax receipts, of a declining amount of tax receipts, just in interest expense. And so then you get into a question of, okay, do we just add the interest expense to the total, or do we start printing the money to pay the interest expense? And you can see how there's just how they're cornered effectively. And so to me, I continue to really like gold, because I think I understand why it is sold off. But from a bigger picture standpoint, I don't think it matters because of COVID pulling forward this fiscal crisis, because of the political untenability of cutting any of these spending programs. The only out is for the Fed to ultimately cap U.S. Treasury yields at politically expedient rates, and politically expedient means at rates that don't bankrupt the U.S. government, and that's going to require lead to increasingly negative real rates. That's going to require increasing Fed balance sheet growth going forward, in my view.
Hence the name of your company. So you're saying they need them to go more negative. They need the rates to go more negative, because this is all a part of this general central bank plan philosophy that was discussed on this meeting. So they actually need it to go down. So they will force it down. That's what you're saying.
Yeah, what they said is look, if what they said was that their debt to GDP is a stock, right? A stock of debt over a flow of GDP. So it's a stock to flow measurement. It's not a stock to stock measurement, is what they say. So, okay. And their point then was, well, if we use a stock to stock measurement, we can do that by adjusting GDP from just this year's GDP to the net present value of all future GDP of the US. And so if we use all future GDP of the US, that is, I forget at what rate they use, something from Social Security. At any rate, it was a $3.9 quadrillion net present value of all future U.S. GDP. And if we look at U.S. debt relative to that, it's pretty modest. It hasn't grown since 2004. And then they said if we keep rates below the rate of growth of GDP, then the net present value of U.S. GDP is infinite, which means we will never have a GDP problem or a debt problem. And all of this is academically is 100% true. The math is the math. They're right. The question is that they don't address is you need to find a sucker at the card table who will hold debt that loses a little bit of value or loses a lot of value every year on a real basis relative to GDP, relative to inflation, et cetera. And in the real world, in the real markets, suckers at the table in the amounts they're talking about don't exist. You're talking about someone that needs to hold trillions of dollars of treasury debt at significantly negative real rates for a long period of time. In other words, you need somebody who's willing to take multiple trillions of dollars and throw it in a bonfire and watch it burn. And such a party in the private world doesn't exist. There's only one person that's going to be able to do that, and that's the Fed and other central banks. And so when you say, okay, well, how's the Fed going to do that? The Fed can make interest rates whatever they want. They can control one of two things. They can control the quantity of money and let the price of money, interest rates, float, or they can control the price of money, interest rates, but then the quantity of money, their balance sheet, et cetera, has to float. And our call has been and continues to be, they made the choice. They faced that choice last September with the repo rate spike. And repo rates went to 8 to 10%. They had a choice. They could say, we're going to stay right where we are and we're going to leave repo at 8 to 10%. And the world would have come unhinged. You would have had mortgages at 10 to 12%. Housing market would have crashed. You would have had treasuries at 10 to 12, 10 to 11%. The U.S. government had trouble rolling their debt. It would have been a disaster. They didn't. They came in and fixed it. They started growing their balance sheet again. They did so again with COVID. So in my view, they've made their choice. And so they're going to have to, I think, take real rates increasingly negative in coming years. And I don't think it matters whether the vaccine, how fast it's rolled out, how successful it is, how fast the economy recovers. I don't think it matters. I mean, I think it matters a little bit for the near-term path. And I think that's what we're seeing a little bit with gold. It's gone from being, oh God, gold wins no matter what, to, oh God, I don't need any more gold, because, you know, we're back to good times are here again. And I don't think that good times here again narrative is the correct one.
Yeah, it's been interesting to watch the narrative on gold change so much. So I always get happy when really, really, really smart people like you say nothing's changed at all. It's interesting how much the emotion moves even something that is as logical as gold. What do you think the end game is for gold?
I think the end game is some sort of either significant rally or it gets brought back into the system at a much bigger number, at a much higher price to effectively recollateralize central bank balance sheets and reset the system. That's where I think this ultimately goes. Now, does that go? If that happened next week, I wouldn't be surprised. If that happened 5 years from now, I wouldn't be surprised. At 10 years, I don't know that we have 10 years, but I would never say never. I think that is where I think this all goes, which is effectively, Ken Rogoff really said it best in a piece he wrote 4 years ago, almost 5 years ago now, where it was an article in Project Syndicate where I think it was entitled "Emerging Markets Should Go for the Gold," and he advised that that emerging markets put 10% or more of their FX reserves into gold, because unlike debt, gold has no limit on its price. And so he's sort of telling you where you can go with that, where basically once you get to the zero bound, you can really only credibly take rates so much, so negative. And then you've got to find something else to a risk-free asset to expand. And so I think ultimately, as central banks grow their balance sheets, there's one asset on their balance sheets that they can expand to recollateralize their balance sheet to sort of reset the system, and that's gold. And so I ultimately think that is the end game, is some sort of significant expansion of gold in price, and that de facto makes gold the primary global reserve asset once again, like it was from 1946 to 1971. Except at a much higher price.
That's what I think. And I mean, I'm irresponsibly, as they would say, I'm irresponsibly long on gold. And it's the only thing, if I'm objective, it's the only thing I think makes sense. There's the crowd that says, no, cryptocurrencies are so great, they're going to overthrow it. Well, you got to understand, why is it that banks buy gold? They don't buy it just because it offsets their balance sheet. They don't offset it just because it's money. It's because eventually they can set the new rules for a new. Why else would they be doing it? I just can't see rationally how they would. Do you think that this is a methodically laid out plan, that they are aware when the dam eventually breaks on fiat currencies, they will just have it prepared to do it?
I think there are, I don't know if I'd go all the way to a logically prepared plan, but I think there is.
I took you to tinfoil hat land too quickly, or what?
No, it's just that the world's messy, right? But I do think that directionally there has been, when you sort of read the tea leaves or you put the tea leaves together, you can see little glimpses of it. It's almost like there's a conference room where there's a conversation taking place, and you're outside at a desk and the door's closed. And every time someone comes in and out of the conference room, you hear glimpses of the conversation, and the door swings back shut and you don't hear anything else. And so the things we've heard, you can look back, you can see, okay, in late 2010, the head of the World Bank, Robert Zoellick, who went on to consult with Goldman Sachs, he's a very, very well-connected, deep thinker. He said, listen, we need a currency system where The yuan gets into the IMF SDR basket, and has an open capital account or partially open capital account. And we should consider employing gold as a reference point for all these currencies as a neutral reserve asset. And it was really mind-blowing to people at the time. And then you look and see, okay, well, 5 years later, the yuan did go into into the IMF SDR basket. China has been moving to open its capital account on a very, very limited basis, primarily through oil markets. That was November of 2010. You then fast forward to February of 2011. You have IMF under Dominique Strauss-Kahn. They had a white paper talking about moving the pricing of critical commodities like oil and gold into IMF SDRs and away from the dollar. You had the PBOC in early 2009 write a white paper, 3 pages, filed it with the BIS, said, we want a neutral reserve asset system. And so you can see this path, these conversations have these sort of glimpses of conversations, snippets of conversations that have happened where basically there appears to be, and I'm going to say it's a generalization, but not too much of one, Eurasia, Europe, Asia, Russia, China, they want a system that has a neutral reserve asset. They do not want the dollar to be global reserve currency and treasury bonds to be the primary global reserve asset. They understand that that's the problem with the system. And so, but they also don't want, everyone says, well, what's going to replace the dollar as reserve currency? Nothing's going to replace the dollar. None of them want to replace the dollar as the dollar has been structured since 1971, because that means they have to run massive deficits. They have to hollow out their domestic economy and their domestic manufacturing sectors. They need to offshore their jobs and factories to some other lower cost country, which in a lot of cases doesn't exist. What they want is a system where you settle any surpluses or deficits in a neutral settlement asset. It's not the sovereign debt of any other country. And the list on that's really short. It's gold. And there was talk of maybe IMF SDR bonds at some point. That's almost 10 years ago now, and it's gone nowhere. You can see global central banks that have been buying gold pretty much the whole time, particularly in Eurasia, whether it's buying or repatriating in the case of a lot of European countries. You've seen things that were quietly approved, like last year when the central bank gold agreement, which had been in place for 20 years from 1999. It was renewed every 5 years, and it provided that European central banks would not sell more than 400 tons of gold in any given year. As a practical matter, they hadn't sold barely any gold for 5 or 6 years, but it was always faithfully renewed every 5 years until last September, and it was not renewed ever. It was not renewed for the first time in 20 years, which I thought signified no one has any plans of selling, and so it doesn't need to be in place. And people I checked in with suggested the same thing. So when you start looking at these sort of snippets of conversations out of the conference room, that's why I say I don't know that it's been a plan, one sort of continuous plan, but you can see very clearly conversations, snippets of conversations, and they all seem to sort of point in the same direction, which is Eurasia wants a neutral reserve asset to settle trade, and gold seems to be the only thing that fits the bill. And if gold is going to fit the bill in some capacity, it needs to be made much bigger relative to global trade. Right now, just to settle oil trade alone, the oil trade is 10 to 15 times the gold. Annual production of physical oil in dollar terms is 10 to 15 times the annual production of physical gold in dollar terms. And so that's where I think you can just see these snippets where I think gold has some sort of role as a neutral reserve asset in the new system, and it's got to be much higher price for that to happen. That's where I think ultimately this end game goes, some point in the future.
What type of price do you think that we need if that was where they're going?
So there's a lot of different ways you can look at it in terms of sort of a PE ratio for gold. The one I've used that I think is at least gives us a framework is Since the dollar is the reigning global reserve currency, since the Treasury bond is the reigning global reserve, primary global reserve asset, we can look back, going back to, I don't know, 50, 60 years, 70 years. If you look at the market value of the U.S.'s official gold, and then you compare that to the total of U.S. foreign held treasuries outstanding. So prior to 1989 is when the Berlin Wall came down, USSR broke up. The ratio of the market value of U.S. official gold relative to foreign held treasuries outstanding was never less than 20%. So basically, at market, foreign held treasury debt in the United States was always collateralized at least 20%. And when there were real questions about the dollar, like in 1980, it was 133%. Now that's a gold bubble in my view. So if in 1980, when the market value of the U.S.'s official gold is 133% of the debt outstanding, in theory, creditors could have shown up, taken gold, cleaned the U.S. out of all their gold, traded in all the U.S. foreign debt, and we still would have had a third of our gold left over. So we were our debt was 133% gold back. That's a gold bubble. Fast forward to today, that number's about 5%. Maybe it's 6%. But the point is if we use that as our PE ratio, the debt, just to get back to 1989 levels, gold would need to rise 3.5 to 4x, which would be, what's that work out to? $7,000, something like that, $7,500. And if there was actually a real question about the dollar, leaving out all of the other obligations in terms of off-balance sheet, banking system, public pension, all that other stuff we started off talking about, 133% of foreign held debt outstanding is about $40,000 per ounce. So to me, the range, using that gold PE ratio, the range of gold's price, if gold really goes back into the system in a big way as a neutral settlement asset, is, call it 7,000 to, I haircut the 40, say it's $7,000 to $30,000 per ounce is, I think, the true primary reserve asset fair value for gold.
Geez, I need you to pump me up every morning. All right. So I wish we would have spent I'm just joking, but I wish we would have spent the whole time talking about gold. It's my favorite subject, but I know you study so much macro stuff. So I thought it would be interesting to get your whole perspective. And I know your time is valuable. I don't want to take up too much of it, but man, that was really, really amazing. Really appreciate the work you're doing too. Before I ask you a couple quick final questions for everyone that's still listening, obviously Luke's got an abundance of knowledge and obviously has some amazing services and research. So if you want to let everyone know your website, your services, everything like that, then I want to ask you a couple quick endings.
Sure. So if you're interested in learning more about our research product offerings, what we're up to, you can check us out at fftt-llc.com, and a couple different research product offerings available. You can find all the information about it there. And also a pretty active Twitter feed at Luke Gromen, LukeGromen.
Awesome. So final questions on gold. So a lot of people scream price manipulation when the price goes down, although there is a logical, objective explanation because the rates were rising. Are you in the camp of that? And there's people that say it's so manipulated, there's no point in even owning it. It'll never go to $7,000. It'll never go to $3,000 because it's so manipulated. What are your thoughts on
that? So my view on the manipulation is a little different, and it's twofold. So I think there's two ways to think about the manipulation. I think in the short run, having the futures market, having a cash settled futures market on a monetary asset like gold shifts price discovery from supply demand fundamentals, physical supply demand fundamentals, to whoever has the biggest balance sheet. And the reason I say that is gold has a very high stock to flow ratio, right? So if you look at all the gold that's ever been mined relative to what's mined every year, that's your stock to flow ratio. And it's, for gold, call it 60x. And that's how you define a commodity versus a monetary asset. So gold has a stock to flow ratio of 60x. Oil, when oil supplies are really high, oil stock to flow might be 1.4x. And when oil supplies are really low, they might be 1.1x or 1.2x. And the point of the high stock to flow ratio being a monetary asset versus the low stock to flow ratio being a commodity is that when the stock to flow ratio is really low, you can't have a gigantic separation between the physical fundamentals and the paper market price for very long, because you're going to end up having shortages. It's almost the way to think about the stock to flow ratio is how many shells do you have to hide the P under? So in oil, you've got a 1.1 to 1.4 shells to hide the P under. And so you're never going to be able to really fool the guy guessing for very long. Whereas with gold, you're going to have 60 shells to hide the 1P under, and the P being the supply-demand fundamentals. And so the cash settled futures market, where you have leverage deployed, means it really can separate the physical supply-demand fundamentals for an extended period of time. Now, that is exacerbated in the short run by leverage, right? So you see, typical trading stuff. You run the stops, right? If they've got a bigger balance sheet, you see all the speculators leaning one way, you come in with a big sell order, they have to cover. It's sort of that kind of stuff is sort of, to me, that's the manipulation I let a lot of people talk about. And look, I guess it is what it is. Clearly, you've seen you've seen the admissions from some of the bullion banks that they were doing this type of spoofing to try to basically drive price. That to me is sort of the small sort of picking up nickels and quarters in front of a steamroller type of manipulation. To me, the thing that doesn't get talked about nearly enough when we talk about manipulation is the fact that paper markets were allowed to expand as much as they were allowed to in gold, because that is really where the manipulation is if you wanted the manipulation to stop, all you would have to do is regulate. Look, banks, have to have position sizes, and the bigger issue is the unallocated gold market in London, where if you say, okay, you are not allowed to offer out more than 10 ounces of paper gold for every 1 ounce you have. And if you did that, you would drive a monstrous price squeeze higher, because then suddenly the demand, when dollars flow into gold, there's two release valves. The price of gold can rise, or the amount of paper claims per physical ounce can rise. And the reality is that optionality of price or leverage has a lot of times been resolved by paper leverage expanding. And that's been the problem. Now, why would I own gold if that can happen? Ultimately, they can keep this game going really for a long time, forever. However, in the long cycle, things get to a point where suddenly, at some point, it's in their interest for the price of gold to rise. And that doesn't happen often. And when I say they, central banks. So think of the central banks are suddenly having trouble generating inflation. They have all the things we talked about before. If the price of gold starts rising, then suddenly that's going to be communicating something to rates markets, to inflation expectations, et cetera, to say nothing of the potential for some sort of reset or the potential usage of gold in some sort of settlement capacity. And so I think that's why I say my view is a little different on the manipulations. I think just structurally there has been this interest to keep gold contained. And the structure of the market does allow that. Basically, the existence of cash settled futures, the expansion of unallocated paper derivatives in London allows that. But now you're in a world where Eurasia wants a neutral settlement asset, and they want gold. They want at some level, you can see their actions, they prefer to use gold. And that's where it starts to get a little bit more interesting. And I think it's one of these things where it's none of this stuff's going to matter, and then it's going to matter a whole lot. We're going to wake up and go, how did I ever think that 1,800 was the real price of gold when it was clearly, 5,000 or 3,000 or 4,000, 7,000, whatever the number is.
Yeah, well said. I also wonder if it's also a price control mechanism for the vested interest and powers to accumulate more of it. I mean, it does China a favor, it does Russia a favor, it does the central banks a favor. That's for damn sure. But you believe, I guess, in conclusion, that there is a point at which it will stop.
Yeah, I think when it's in their interest to stop, they'll stop it.
And it is in their interest, I guess.
It's very much in their interest right now. Even if you look at, for example, the accounting manual for Federal Reserve banks in the U.S. I was looking at it the other day. We wrote about it in our Tree Rings product, which is if the Treasury tells the Fed to remonetize the gold, then the difference in price would be deposited into the Treasury's general account at the Fed, and the Treasury could then spend that money. So one way for the U.S. to, for example, completely delever its balance sheet in a hurry if it wanted to do it would be Treasury calls the Fed, reprice the gold at $10,000 an ounce, $5,000, whatever, multiple trillions of dollars into the Fed's Treasury general account, or the Treasury's Treasury general account, which the government can then turn around and start issuing checks for whatever they want. And into the economy accelerates, and away you go. We wake up, we have a booming economy. We have a debt to GDP that's suddenly sustainable again. And all of that could happen. Like that is, is that my base case? No, but that's what I mean about where it's in their interest. We're now getting to a point in the long cycle of debt where they don't have a lot of options. They are, when you're talking about using non-GAAP stock to stock, GDP is infinite as long as we keep rates below, the growth rate of GDP, you're running out of options. And so, one thing we know is they're not going to say, okay, we had a good run. We're just going to close up shop as Washington, D.C., and we're going to fire the Defense Department and we're going to not send the checks. And that's not going to happen. And so then it comes down to, do you want to just keep running up the debt total and doing this? Or do you want to, or running up the debt total, you want to run up the Fed's balance sheet, which is good for gold? Or do you want to just do the big bang and say, Treasury here, write it up, give us the difference, and we're going to spend that in, and we're going to basically pay down, we're going to delever the system, give it a turbocharge, and, we'll do Green New Deal, we'll compete with China, so on and so forth. So there's some things out there that I think are possible.
Do they know that? I mean, I've never heard somebody throw that. Do they know that stuff? Like what? Where did you think of that?
Somebody knows it. I don't know that many know it, but somebody I suspect knows it. Like I said, it's in a manual. I had somebody pointed out to me. I read it. I'm like, holy cow, they could, and the way you can do it is if you go back to say 2012, 2013. Remember, there was the budget, the debt ceiling issues then, and Paul Krugman wrote about. If you remember the $1 trillion coin solution. Now remember, they said there's going to be $1 trillion platinum coin. They never said gold ever once. And I suspect there's a reason for that. But Paul Krugman wrote about it in the New York Times. I read the article again last week, which was, well, we could technically have them buy a coin for $1 trillion, mint $1 trillion coin, and pay for all this stuff. And it's the same solution. They just use the gold.
Wow. I know I'd heard about that platinum thing, but it was so distant, and I definitely didn't think of it. And I guess that summarizes your business once again, is not missing the forest or the trees. Amazing stuff. This was, this was fantastic. For everyone listening, please make sure you hit the like button on either side. Leave a comment down below. If you learned something or you want to have Luke back on, please be sure to head to his website. Obviously, this guy is a wealth of knowledge and has some amazing research. So please head over to his website.